Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate. This week up, Docusign. We are going to go through this annual 10K just filed for 2021. The fiscal year end January 31st. So it's January 31st and back 12 months. We're going to go through this 10K. We're going to look at 9 years of history of Docusign. We're going to look at an Analyst Day presentation that they put out on what they think the future of the company holds. We're going to figure out what we think the forecast looks like and what the value that we believe Docusign is. Then we look into the public market to see what we can buy it for and if there's an economic return. All right, ready to do it? Let's get to work. All right, Docusign behind me. Let's dig right into it. But before we do, let's review the 5 key attributes that we use to value all of the securities here at Rational Investing. And that would be 1, top line revenue growth. We've got to see it. 2, earnings growth. We need Ebitda growth to be strong and positive. 3, we need strong free cash flow. 4, we need low debt, less than 3 times debt to Ebitda. And 5, we need a well-priced stock. A stock that has an enterprise value EBITDA multiple that's reasonable. It doesn't have to be super cheap, but it can't be super expensive either. That's what we mean by well priced. All right, those are the 5 key attributes that we use to value all of our stocks. Let's dig into Docusign. Okay, behind me is the balance sheet that they show in their 2021 10K. Current assets, $1.12 billion. That is a lot of jack. Good for them. Love to see that. And I certainly love to see this curly number that right there, $566 million of cash sitting in their checking account. That's fantastic. They've got an extra chunk of cash, $207 million in investments current. That's their investments due within 1 year. We're going to add that back as excess cash, but I'm going to leave the $566 billion in there as part of the ongoing working cash that they need to run the business. So they've got a lot of cash in the balance. Let's take a look at the balance sheet, $2.3 billion. When I look down this list of chunky assets to see what's their backstopping any debt that they might have or backstopping my investment as an equity owner, right? We've got some big numbers, $350 million. I got $121 million, and I have $260 million. That's about $730 million, and that makes up Goodwill, Intangible Assets, and Deferred contract acquisition costs. Now, these are very interesting because they are not real assets. You can't sell them for cash if the company were to, for some reason, go bankrupt. Not that Docusign is at risk of going bankrupt just yet, but in the off case, us as equity owners, we always want to make sure that we are in the positive position, meaning we're as close to the assets as possible, and there's as less debt between us and the assets as possible. And when I look at assets that could be liquidated to pay me out if for some reason the company went bankrupt, and I went to the judge and says, "Judge, I put in $200, give me my money back," the judge is going to say, "Well, what kind of assets can I sell to pay you back?" And he's going to look at this section of the balance sheet, and this stuff here is not something physically that can be sold. The Goodwill is generally the premium paid on other acquisitions they have made. That's not really an asset you can sell. That's worth zero. Intangible assets could be like a brand name, could be a patent, but that's more of an asset. It's more of an intangible, meaning customer lists. It could be agreements that have been signed in the past. Those are tough to monetize. They're tough to sell. So generally, there's not a whole lot of asset value to subscribe to that. And then deferred contract acquisition costs. This one threw me for a loop. I had to read the 10K. It's basically the cost that Docusign pays to their sales team in commissions when they sell or sign up a new customer for Docusign service. And I don't like these kind of assets. We see this with Facebook. Disney does it. There are lots of companies that do it. But I would prefer them to pay the cost at the time the deal is closed, get it off the balance sheet so that this section is clean. What that does is it says there's $260 million of costs that have not been shown on the income statement yet. This will eventually be written down over time and slowly, piecemeal, sprinkled into the income statement over time. Reality, it should have been written off right away. So I get that there's lots of companies do it. This is obviously an audited financial and has been signed off, but I would like to see them just write that down and be done with it. Expense it as it happens. But needless to say, this is a relatively small percent of all these assets. So I think in an asset position, they're quite well balanced. If I look at total debt, come down here, current liabilities, that's the AP, the normal workings of the business. And you've got here the current contract, current liabilities, and some other stuff. That's generally the working nature of the business. $1 billion is fine. And you've got this number here. This is a convertible note that they just issued of $700 billion. That's that $1 billion. When you dig in the detail, it's very interesting. They raised that money this year at a 0% interest. And I had to read it twice. I was like, excuse me? Investors gave Docusign $700 million at a 0 interest rate. Why? Well, they attached options, a convert right to that debt, so this debt can be converted into equity at about $400 a share. When I do the math, I get an extra 1 million shares or so that this debt will be converted into and dilute us equity owners. So I want to note that a little bit. It's not too big to where it'd be a deal killer, but it's just something that they use to finance their operations. Total debt then $2 billion. This minus this gives me the equity position here of positive $335 million. I'd like to see that number a little larger, frankly. I was surprised to see it as low as it is. But the debt statement is pretty decent. Let's give a smell check to the income statement. Income statement, total revenue, 2021, $1.45 billion. Congrats, guys, almost $1.5 billion. You got a huge run up here, $700 million, $973 million, $1.5 billion. Kudos to the sales team for really kicking butt there. Gross profit is growing. Software should have high gross margins, which you see here. This is the section that they start losing me a little bit. Most startups, most software companies, right, they're spending heavily in marketing, R&D, and shareholder comp. That's like the soup du jour. Not shareholder, employee comp, employee stock comp. That's like the soup du jour these days. So here's sales and marketing, $800 million. So almost all this gross profit is pretty much eaten up by sales and marketing costs. You tack in almost another $300 million, 271, for research and development. That's, I guess, to defend their position in the market. So that's not really going to go away anyplace. And then another $200 million rounding out the SG&A bucket means that to run this business, to generate this amount of cash, $1.5 billion, they had to spend $1.2, almost $1.3 billion in R&D, which, fine, that could be future product development, but you still have to spend it as part of the business. You've got sales and marketing to sell it, say, hey, I'm out there. And then you've got SG&A, administrative costs. So that's a lot of money. And what happens is they really don't make any money, which I was surprised by. I get when they're smaller, operating loss, negative $420 million. Like, okay, that's kind of a lot. But as they scale, right, this is what's that, a 40% move or so? The loss comes down to 191, and then it goes up almost to 1.5 billion, and they're still losing money, which I would have liked to have seen them squeak out a little bit of profit. I think that's totally within reason. They're spending because the equity market is funding their losses, so they're like, why generate profit? But come on, guys. You crush it at the top line. Give me a little earnings to work with. But all in all, it's pretty clean. Here's your weighted average shares outstanding. And then here, this section I thought was interesting. They're actually breaking out the stock-based compensation as it relates to the different buckets on the P&L. Typically, it's kind of buried in maybe this SG&A bucket at the corporate headquarters here, general administrative. But because every employee gets it and they're a software company and some of the employee costs sit in COGS, they kind of sprinkle it throughout the P&L, so they summarize it down below. Okay, let's take a look now at the cash flow statement, my favorite statement, your favorite statement, the cash flow statement, right? So 2021, net loss, $243 million. We're picking up where the P&L left off. That we just saw the P&L before. Now we're going to convert this into cash, and you're going to see cash positive $243 $296 million after a whole host of in and outs. Some of the big ticket items, depreciation, $71 million. You're going to add that back for your EBITDA number. $99 million. You are not going to add that back. That is the amortization of the contract acquisition and fulfillment cost. That is something that should have been expensed on the P&L. It's non-cash here because it was paid in prior periods, but don't add that back. That's a cost that should have been expensed a while ago, was not. Therefore, you have to count it at some point. So I would leave that in the EBITDA calculation. Amortization, so forth. Let's keep going down here. This one, stock-based compensation, big curly number, $286 million. Prior to that, 200. Prior to that, 410. Now I'm going to go through their Analyst Day presentation here in a little bit. And when they talk margins, when they talk earnings, when they talk profitability, much like a lot of the software companies that are out there, they're adding back this monster number, which I think is a no-no because you're actually expensing this number. This is to employees as part of their compensation package. When they sign a contract and say, hey, I'll come work for you. Here's my base, here's my bonus, here's my equity slug. That equity slug they are counting on achieving. And if it doesn't happen, they will go to another company that gives them that equity or gives them a higher base salary. So you can't zero this out as a result because you lose your employees. So therefore, this is an actual cost. It belongs in the EPS, and companies who add it back or do the adjusted EBITDA number where they add it, they exclude it from EBITDA is not right. So we're going to expense that. But going through, so then you add that back here, you get this positive number for operating income, operating cash flow, and what you'll notice is this is mainly the share-based comp. So if I take this share-based comp and I expense it, this cash flow is roughly zero. So let's keep going down the P&L. That's cash flow from operations. Let's look at CapEx. CapEx, purchase from property, plant, and equipment, $82 million. Pretty light. It's a software business. No harm, no foul. I think everyone expected that. Here's your issuance of debt, right? This lower third's the financing section of the cash flow. This is operating. How much did I make running my business? This middle section here is investing, what I do with the cash that I made. And then the bottom section is how do I finance it? Did I borrow debt? Did I pay down debt? Did I issue stock? Did I pay back stock? Did I pay a dividend? That's all right here. And it's typically very clearly labeled. For instance, proceeds from the issuance of convertible senior note. Convertible senior note means debt. Convertible means it converts from debt to equity. That's what I referenced before. And how much did they raise? $677 million. Boom, easy. Positive numbers inflow, negative numbers outflow. And you got an outflow, repayment of convertible securities. So what they're doing here is they're paying off one piece of debt by borrowing another piece of debt. Just kind of rolling this debt over. Each debt had convert rights, so each debt owner gets to convert into equity, adding dilution into the equity pool, which means you and I are getting diluted. There's more people coming into the pool as we're trying to hang on to our investments. So that's a concern for me. This one was shocking. So payment of tax withholding obligations on RSU statements and ESPP purchase. $372 million. That's a big number. 166 before that and 215. These are real dollars, outflows of pure cash. What is this? This is the taxes that the company pays when they issue employees options and RSUs. RSUs, restricted stock units, right? So this is how do I get you to stay? I'm going to give you stock, but you can't take it yet. There's a vesting schedule. Well, there's tax consequences there that the company pays. And then ESPP, employee stock purchase plan, again, based on the gain that they awarded stock with people, they have to pay taxes, and that's real cash that's going out the door. Okay, that's a quick dive in the cash flow. Let's go take a look at how it stacks up in our chart and see where we go from here. All right, let's take a look at what we just saw and give a little bit more detail, as much as I can gather, because they haven't been public for too long. So what you'll see, revenue in 2016, $250 million has grown to the number you saw, almost $1.5 billion. Again, kudos to the Docusign team for the hard work. Great job, $1.5 billion. That is a fantastically large number. Love to see that. EBITDA is negative. Now, Not only is it negative, but it's pretty flat negative. This was surprising. So I get it, you're losing money here because you're young, you're IPOing, you're growing fast, got it. $250 million, you lost $100 million, okay. What I would have liked to have seen is just a little bit of profit, guys. Just that much, because you went from 250 to $1.5 billion, and you're telling me you can't make a single dollar in profit? I mean, I get you're reinvesting for growth, blah, 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 the whole thing, but have a little bit of respect for the cash flow investor and say, hey, just give me a little bit, make it a zero, something. But I didn't like that. I would have liked them to have seen some economies of scale here. The problem with this is the argument is always growth at any cost. Oh, they'll grow into profitability. So buy now because as they scale, they will obviously become more profitable. Here, this is contrary evidence, right? This is 6 years of data. They have gone from $250 million to $1.5 billion, and they can't earn a single penny? Okay, so I think the idea that you scale and become profitable is questionable, but we'll keep going. Negative numbers, obviously, for here. Long-term debt, they have some debt, like I referenced before, the convertible note. When I add it all up, it's $916 million. They have a little bit of excess cash, mainly because they just raised a bunch of debt. But that cash, because it is not necessary for operations, given that it's in the investment line, not in the cash line, I'm going to add it back with the enterprise value. Market cap, $46 billion is a very strong market cap. That's average shares outstanding times price. I use January average because this is the fiscal month end. So I get $46 billion. I add the debt minus the cash plus the market cap, and I get enterprise value. Enterprise value is the whole enchilada. That's exactly what we want. When we're looking at EBITDA, is enterprise level without debt earnings. Enterprise value is the enterprise adding back all debt. So you want that number. If I look at our metrics, dividing EBITDA makes no sense because earnings are negative. And then looking at debt coverage ratio, it makes no sense because earnings are negative. This is why it's very difficult to buy cash flowing companies that don't produce cash flow, because it's basically a wing and a prayer. You got to assume that at some point they're going to have an inflection point, even though they haven't historically. Right, the last 6 years of data, they haven't become profitable. But suddenly, if I take this number and add another zero to it, then they become profitable. I don't know about that. Right? You should be able to turn a profit at $1.5 billion. Just saying. Okay, so this is the enterprise value. Let's go take a look at cash flow statement, and we'll take a look at free cash flow to equity. Okay, free cash flow calculation, what you'll see here is 2016 negative $86 million, and then it turns positive 2021 $297 million. Now that's very interesting. First off, kudos for turning the cash flow around, but then secondly, what you and I always talk about is an accounting smell check. You want to see EBITDA moving in line with cash flow from operations, even if cash flow is positive, which is what we want. I mean, I'm glad to see this number positive, but why is EBITDA flat and negative and cash flow from operations rising and positive? Well, let's go back to our cash flow statement and I'll show you why. So here's our cash flow statement for 2021. Here's the cash flow from operations number I just referenced. And why is this number so big? Well, it's big because they're adding back the stock-based compensation, which we said we shouldn't do, okay? And second, they're excluding this taxes that they have to pay on the stocks that they're issuing. So what's going on here is the EBITDA is reflecting some of the stock-based compensation that they're giving out. It's a non-cash cost, so it's being added back in cash flow from operations. This number is large, but this section of the cash flow is not does not capture the cash taxes that they have to pay on the stock-based comp that they give out. That happens to be in the financing line down here. So what happens is this number is positive because it's missing a piece, and that piece is the taxes that they have to pay on the on the stock awards that they give employees. And if you did that, this number would be zero or negative, which would be in line with the EBITDA number. So let's keep going. CapEx here, CapEx is really thin. Like we said, it's a software company, so there's not much CapEx. Debt payments, almost $300 million coming in. That's the net of the $700 million convertible note and the refinancing and the paying off of the $400 million note gives me about $300 million cash in for a total free cash flow to equity of $500 million. Now, this is the free cash flow from operation your math exercise does, but you got to take a look at it, read the 10K, give it the old smell test, and realize two things. One, this debt is kind of a one-time deal. They have negative earnings, so our standard ratio of debt to EBITDA doesn't work. I'm not going to allow them to continue to take this cash out as though it were free cash because it's not. They don't have positive earnings to support this debt. So I'm going to take this out of there and call this 500 minus the 3 a $200 million. So that 5 is now $200 million. And what I'm also going to do is correct for this overage right here. This does not have the cash taxes in it. So I take out that $300 million, I get this adjusted free cash flow to equity. Adjusted free cash flow to equity, where I'm taking the $500 million, less the debt, less the taxes paid, and I get minus $100 million of pure cash flow to equity. And these numbers here, doing it each year, these numbers are much more in line with the EBITDA numbers that we were saying. So, long story long, I think we've got the EBITDA moving in line with an adjusted free cash flow to equity. They're now in line with each other because we had to dig a little bit deeper. You can't just plug and play. Sometimes you got to think about it. So now I've got a cash flow to equity that's smell checking right. I'm including the cash burn of the stock-based comp that they're giving their employees. Let's round out this chart and then let's look at their analyst forecast. Next big thing I love to look at is the share count. What is the count doing? 165 million, 179 million, 191 million. It's increasing, right? They're issuing shares about, I think that's about 8% growth. This is about 7% growth. So mid-single digit equity issuance every year. That is the most likely the conversion of the convertible note and stock-based comp for employees. So the employees are joining us as equity owners, which means that the pie that we have available to us is getting sliced thinner and thinner. So any free cash flow that we end up generating, you've got more people fighting over this number. So what happens? Your cash flow per share goes down, right? So it happens to be negative because these numbers are negative, but then you're taking this number, you're dividing it by a bigger number, so you get a smaller number, right? Smaller. Share price is just the average share price in January. You can pick what month you want. I use January because it corresponds with the fiscal year end. $241 a share is a big price, a big move in the last couple years, up from $44. That's pretty big. In my mind, that looks like it's pretty rosy. I think the analysts say, or the street calls that being priced to perfection, perhaps. So we'll take a look at that in a bit. ROIC is negative because operating results, the note plat's negative. Free cash flow yield's negative because free cash flow is negative. There we go. Now what do we do? Okay, let's review. Top line revenue growth, crush it. EBITDA, negative. Debt, large, against negative earnings, doesn't match. That doesn't work. Enterprise value level EBITDA doesn't work because it's EBITDA is negative. How do you judge that? Free cash flow is negative. Why? Because they're paying it all to the stock to employees and stock-based comp. So there's not a whole lot to go here. My early thinking here is that it's not checking any of the boxes, but I want to give some credit to management and say, let's take a look. Investing is about what the future holds. We try to use the past as a guide because it's the only factual information we have. Anybody can predict the future, can come up with a forecast. The idea is what's really going to happen in the future that we want to have. So I think when I look at the actuals here, it's highly unimpressive, mainly the scaling of the business, the primary argument that people say they need to buy growth and revenue is not working because they're not making any more money. So what we're going to do is we're going to take a look at their forecast. We're going to plug that in. Then we're going to look at the result and say, does it smell right? Do you want to buy it? And then we'll make a call from there, okay? Let's do this. Okay, behind me is their Analyst Day presentation, March 24, 2021. They've released. We're going to go through this and pull out some pieces. I'm going to skip through a lot of it because it's long. But the very first thing I want to do is whenever you read this, or even earnings releases, or listen to earnings calls for that matter, that's a whole other conversation, earnings call. You know that they can cherry pick who calls in, right? So they know who's calling in and what kind of softball question they're going to get. It's not exactly a fair playing field, but that's a conversation for another day. Earnings presentation. When you look at this stuff, put on your hat that this is a sales doc. Why? Because everybody who had a hand in making this thing has stock in the company or has a job in the company and has a vested interest in making this as rosy as possible, as to at least put a tint of positivity on the data because A, it reflects their own work, and nobody likes to say, hey, I messed up, or hey, things aren't going well, so that's one. But two, they own part of the company. And just like when people admonish analysts who don't acknowledge that they own the stock before talking about it, you have to realize that everybody in these presentations owns stock, and it's going to tint the way they present the data. Not saying good or bad, it's reality. So let's take a look. The first thing I noticed is that the thing is super glossy, right? Big letters up here, capitalizing on the anywhere economy. That is very nebulous. Good for them. That's very cool and catchy. The next must-have cloud platform, they're kind of telling you, hey, you must have this kind of subliminally. That's kind of nice. But again, if you remember some of the other ones we looked at Amazon's investor presentation a while ago by now. And what was it? The very third slide, cash flow from operations. And the next one was free cash flow. And then it was like debt-adjusted cash flow. All they focused on was was cash flow. And there was very little salesmanship in that deck. And we loved it because we're cash flow hunters. This is kind of the opposite. A lot of razzle-dazzle. Very little explanation around free cash flow, when it's going to turn positive. They use the adjusted earnings numbers where they're adding back share-based compensation. So there's a lot of razzle-dazzle in this thing. It's super high gloss color. I'm sure they spent a lot of time on this. I feel bad for the financial analyst that had cranked this bad boy out, but there's a lot here. One thing I wanted to touch on is this particular slide, which is the TAM, the total addressable market. So they're saying their agreement cloud opportunity. This is everything. This is the market they're going after. And what caught my eye is they're saying their total addressable market is a $50+ billion industry, right? But when I look at their market cap, is right here, $46 billion market cap of a company that's chasing a total addressable market worth $50 billion. So they're already valued at 1 times the entire tangible net worth, entire TAM. But you have other players in here, right? You have Adobe is in here with their Acrobat Reader, and they have a signature product. The Adobe CEO recently said that their annual results, that their signature product doubled year over year. And so inside this, you have lots of competition going after this big number, which makes me question why this company's valued at the entire tangible market. So I thought that was a little bit of a red flag for me. Going through the rest of it, I thought it was pretty glossy. They don't talk on a whole lot of stuff. It's only when you finally get down to the CFO's presentation where they really start laying out a little bit of plan. It's pretty high end, if you ask me. I mean, some of these categories like the foundation for scaling at growth, that doesn't say a whole lot. Robust recurring business model, which is true. Multi-vector diversified growth. I hate stuff like that. That's just jargon. I mean, really, downward is a vector too. I mean, it should. So I thought this was a little hype for me. What I want to get to is this one here. Again, I think They're showing revenue growth here of 54%. A huge arrow saying, hey, just follow us. This path is going to continue. But the reality is this consolidated average growth rate, the CAGR, the reason it's 54% is because it started at such a small number. You're not going to experience the same level of growth being on this larger number, and I'll show you exactly that. So when I look over here, these are the growth rates that they've actually experienced according to the revenue in the 10K, right? So the last 5 years, 50, 52%, 36, 35, 39, 40. So this is averaging, what's that, upper 30s? You're averaging 42% in the last 4 years. They're saying 54%, small difference, but it's a big difference, right? They're leading you to believe that the rate you should use is 54. It's not. The next thing I want to show you is this number here. This is the long-term margin. They're saying 20 to 25% long-term. Again, profitability. Their profitability excludes stock-based comp. So I'm going to take this number, I'm going to haircut it a bit because I think you have to expense that shareholder-based comp. This section here, the very last, it's in the appendix. This is where they actually tell you how they came up with those numbers. And they're taking GAAP operating losses here. They're saying this ties to the 10K I just showed you, right? $173 billion loss last year, $200 billion loss the year before that, $426 billion loss before that. And they're adding back all this stuff up to come up with a rosy number. And here's their 12% operating margin. Well, it's not an operating margin because they're adding all this garbage back, including $244 million of stock-based comp. They should not be doing that. But of course, then they would be negative and they don't want to say anything bad because they all own stock in the business. They want to keep the gravy train going. Hey, I get it. I've made stuff like this before. I understand what goes on in the room and they're trying to make it as rosy as possible. But you and I, as actual investors, it's our cash that's buying this company. So we need to have the black and white. And I'd love to see them elevate this and be a little bit more forthright with the way they present their numbers. Okay, so how do we go forward here? We need to forecast this business. And what I'm going to do is I'm going to take their presentation, modify a little bit, come up with a forecast. We'll then figure out, do we think it's reasonable or not? And what I'm doing here is I'm taking an average growth rate. So this is the average growth rate that I showed you before. 41% is the average of the last 3 years, not the 54% that they showed you in the deck. I'm then decreasing it over time because as they get bigger, it's going to be more difficult for them to grow this number at the same rate. You also have competition coming into the market. I wouldn't be surprised if behemoths like Microsoft started coming out with kind of Docusign-like products, right? I mean, every legal doc I have ever seen has been written in Microsoft Word. It doesn't seem unreasonable that Microsoft could come out with some kind of signature product to lock in what you're already typing in their program. So I think competition is a big risk factor here. So I'm definitely bringing this down, but still very strong. If I average this, it's 25% every year. That's big growth. They go from $2 billion to $13 billion over this time frame. I got a long-term margin. I'm holding it at 18%, not the 22 to 25. So I'm bringing it down for some of the share-based comp expenses, and I get $2.3 billion of EBITDA long-term. So the next piece we need to do is share count. Now they're diluting shares because they have such share-based comp out there. I want to figure out what kind of dilution do I face in the future. And this is a crude estimate of it, right? When we looked the last couple years, you had 8% year over year, then 7% year over year dilution. So I'm picking that up, 6, 5, 4, adding shares over time to try to estimate how many shares will be outstanding long-term. Super high-level guess, but I didn't want to leave it at the same that it was in 2021 because they are diluting. So I want to give it some dilution, and my estimate is 236 million shares. Okay, let's do the EBITDA market multiple approach. Remember, we used two different estimators of a future price. We'll do an EBITDA market multiple base, and then we're going to do a free cash flow base. We'll look at the two and compare. So here I'm taking the EBITDA forecast that I showed you earlier. This is the growth rate that ends up being after focusing on revenue and going from essentially a negative EBITDA to a big positive number. You're going to see really big EBITDA number growths. I'm giving it a 30x handle because that's a strong premium. I think there's risk here that this could be lower long term, but you've got strong double-digit EBITDA growth, 30x. 30 times this number gives me $70 billion enterprise value, less a little bit of debt. I'm using 2 times this number for a little bit of debt. No free cash, no excess cash. $65 million market cap. Divide by the shares I have the forecasted shares gives me a $279 price target long term for Docusign. Now, before we forecast cash flow, we need to come up with what cash flow is. And if you remember, I gave you the adjusted free cash flow to equity number. Well, when I looked at free cash flow to equity and I divided it against EBITDA, what I found was a little commonality between, and this is only very little data, but I'm trying to represent what free cash flow would be based off the EBITDA, and I'm saying that they track pretty close together. Free cash flow to equity and EBITDA, because this is a software company, there's not huge CapEx, these numbers will be fairly close to one another, and there's not a whole lot of debt in the business. So on I average the last couple years, taking my adjusted free cash flow number, dividing it by EBITDA, I get a ratio, which is essentially 70%, meaning EBITDA is 100, then free cash flow to equity would be about 72. That's a ratio or a percentage. So what I'll do is I'll take the EBITDA forecast that I have, I'll take 72% of that to convert it into a free cash flow to equity, and I'll divide it by the shares outstanding I have at that particular year, and I get a estimate of free cash flow per share over time. And it goes from basically $0 to $7, which is very strong growth, very similar to the EBITDA growth that we are forecasting as well. I apply a yield to that of a low yield. Remember, low yield, high price. So a low yield gives me a $478 price target for Docusign out in the future. That's $7.17 at a yield of 1.5%. Okay, so now we have 2 price estimates under 2 different methodologies for Docusign. We have one EBITDA market multiple approach. Market multiples are very prominent. You can get lots of data on what companies trade at. In particular, you'll have press releases. Typically, when a company buys another, they will say, we bought this company at X times EBITDA. So there are lots of great market data you can get on transaction-related multiples. That's why I use the EBITDA market multiple, which is here, $279. But this is rational investing. We buy free cash flow. We buy hard cash flow. So we have to also value the business on a free cash flow basis. In this instance, I got $478. You'll notice a wide dispersion here between this. And this is uncertainty. You've got 2 different methods, almost $200 differential between the 2. That's a big gap. And I think that big gap is coming predominantly because the forecast has to go from negative to really positive, and over that time it creates a wider and wider possibility of outcome. I'll average the 2, $379. It's currently trading at $220. So let's put this into our handy dandy IRR calculator and see what we get. So here's the stream of free cash flow that you own, the adjusted free cash flow that you own. I'm in at $200, I'm at $220, I'm out at $379. I get this net stream of cash flow. And when I IRR this, I get a 7% annualized return. That means every year, on average, I would have made that money over a decade, which is surprisingly low for such a fast-growing company. So let's review a little bit of where we are with this company. This is a subpar return, right? The long-term S&P average would do about 10%. This is saying 7. How did we get here? Well, we had a really strong growth forecast, right? We took a company that has negative earnings, negative cash flow, and we're assuming that that will turn around and grow, even though the evidence that we have in the last 6 years says scale does not create free cash flow, and it does not create positive EBITDA. Yet the company is saying, hey, don't worry, keep going, it's going to get better. So we'll take them at their word. We'll put in a forecast. We'll give some conservative assumptions. And what happens is a subpar IRR. And that to me means that this company is priced to perfection, meaning the stock market is giving full credit to the company and trusting everything they say when they price this stock. And I think that is the error here. I like the company. I think they have strong margins. You know I love the subscription model. But for me, it's way overpriced. I cannot pay $220 for this stock because the IRR is too low. If I were to bring this down, for example, say $150, okay, $150 gives me a 12% IRR on the same forecast. Okay, that is a little bit more market, but of course the stock is nowhere near $150. So for me, I'm going to pass, and I'm trying to debate which one do I give it. Do I give it the meh or do I give it the bad? I'm going to give it the bad. Why? Let's review our 5 key attributes, our foundation, our principle of why we invest. Remember, principles only mean something when they're inconvenient. In this case, I would love to believe the sizzle right here. But we're steak buyers. We're not sizzle buyers. We buy hard cash flows. So let's review the 5 key attributes. Top line revenue growth. Yes, it's growing. Check the box. EBITDA growth is not there. It's flat. Strong free cash flow? No. Strong free cash flow has not been there historically. I'm not going to do it. And then low debt? No. With flat negative earnings, even having debt means debt's too high. And well priced? No. It's not well priced either in the market multiple method, and it's not well priced when I put it into an IRR. The IRR is still sub-market, and in that mind, it is not well priced. Remember, this IRR is your return estimate if everything pans out. So if you buy the stock at 220, you are guaranteeing that this forecast will happen or better. And for me, I'm not willing to do that. I'd rather let the market pull back, or better yet, go buy something else. There are thousands of other opportunities out there that are producing cash flow, that have no debt, that have great growth prospects, and show nice positive curly numbers up here that don't rely on huge growth forecasts. So that is why, for me, at this channel, we're a bad investment. Take your time, go find something else. Okay, this has been Docusign. I thank you very much for watching the channel. I greatly appreciate it. A couple updates before I end. One, there is some clown that's impersonating me on my channel and asking you to sign up for a WhatsApp. That's not me. I'm not going to do that to you. Don't ever respond to that person. I am working with Google to get rid of them. In the meantime, that's out there. Be careful. Also, 2, big announcement. I'm launching an investing course. Well, I will teach you how to do all of this, and I will give you the worksheet. I will give you 10Ks. I go through Apple, the stock, and I walk you through each line item to build the investment case. And I give you a whole lot of other stuff to round out a complete investment course, which I think you're going to really like. I'm really proud of it. It's taken almost 6 months to get done, and I'm really, really excited to launch it. So stay tuned for that. That's it. I'll stop rambling. My name is Cameron Stewart. This is Rational Investing. Thank you very much for watching. All the comments and subscribers. I greatly love doing the channel. Thank you so much. Thank you very much. Talk to you later. Bye-bye.